because we're going to spend a while in it, but we're not going to get past page 20. Fantastic book. Grab yourself a copy if you want to know what else is in this little jewel here. They don't know. This is a point I think I'll do a video on. That a lot of people have the evidence in front of them and never connect the thought. So there's more to teaching than just saying, here's the evidence, and walking away. You have to say, here's the evidence, and here are the connections between it I want you to look at. Now, if the kid can think for himself, he might find them out for himself. But the point of teaching is to show those connections, not just to give the kid the evidence and hope that he is able to discover it the way the geniuses of history did. Point out to him the things the geniuses of history discovered. You know, point out to him the things that the intellectuals who are absorbed in this come up with. Because he's not absorbed in it. So when you put the evidence before him, tell him the conclusion that you're trying to get him to see. That's the duty of a teacher. But anyways, not to get off on the sidetrack. Now in page 1, chapter 1, if ever one day was a watershed in American history, it was Black Thursday, October 24th, 1929, when the bottom dropped out of the stock market. That afternoon, a group of New York bankers succeeded in temporarily halting the plunge, but 5 days later, Wall Street was in a panic again. Thereafter, the prices of stocks and bonds, ironically called securities, skidded downward almost steadily for 3½ years. Now skip a couple sentences. Despite the assurances or incantations of business and political leaders that the stock market crash did not reflect upon the health of the economy in general, you got that? They kept saying, look, this crash doesn't reject upon the economy in general, it's healthy, don't worry about it. This crash is superfluous. It was not long before almost every indicator of the nation's economic welfare showed trouble. What the hell is this? It says the assurances or incantations of business and political leaders that the stock market crash did not reflect upon the health of the economy in general. This is a interpretation. Mr. Saltzman goes over this quite a bit. The interpretation that the 20s was a fake boom, that there was a massive amount of speculation on stuff that wasn't actually going to be profitable in the long run. And at some point, that had to be curtailed, had to be brought back down. The bubble had to burst. So the 20s is a fake boom by this interpretation. And the fact of the matter, Mr. Saltzman goes over, makes an effort, belabors the point. So I hope that it's okay if I take a minute here to talk about this. The fact is, there was a massive increase in productivity in the 1920s. The fact is that companies were gaining, in bounds and leaps and bounds, like they didn't in most other decades, because of two technologies that were key: the radio and electricity in general. I guess we can call those one, or two, and then let's say three, the car. But if radio and electricity are together, and the car is the other one, those technologies were causing so much productivity in the United States, causing people not only productivity in the here and now, but people were optimistic about productivity to come, more productivity in the future, because look at this. They were aware of what was going on. They said the horse and buggy and steam trains for 100 years, and now we get the Model T. The Model T by this time was 14, 15 years old by the time the 1920s starts. But, they say, look, we've been going around horse and carriages, we're free, we're liberated. We can listen to the radio, wireless, anywhere you want, disconnected as long as you have an electric power supply. I mean, it was a magical time, more magical for them probably than the internet age was for us. So there was optimism, and this sort of overinvestment that can happen, which certainly did happen. Price of RCA stock went from, I think, $3 to $168 or some outrageous thing like that, or from $3 to $68. Maybe that's what it was. Outrageous. The price of stocks went through the roof because people saw and wanted to get in on this opportunity, and the stock market boom itself was accelerated a little too quickly. I think that the problem, part of the problem, was the Fed having its interest rates so low. Saltzman doesn't really speak to that. He doesn't really answer that question, I don't think, not to my satisfaction. He seems to disregard it as not too important. But if the private economy would have had its hands on the inflation, there would have been some banks that would have raised their rates. They would have said a boom is impending, or pardon me, a bust is impending, something's coming here, and we are not going to borrow out very much of our money. We want to have a lot of it on hand. Some banks would have done that. They would have been the strong ones that made it through the crash. As we've already seen earlier, the reason so many banks failed was because of government intervention to begin with. So it was all, it's too deep to get out. The government needs to get out in 1,000 different places. There's no way to fix it by taking the government out in this little area or that little area. But if the government would have just allowed interest rates to differ according to which banks wanted to borrow by which rate and not set the national rate like that. Now, I know it only sets the rate by which banks borrow overnight from each other. That's the only rate the government sets. But the reason that it wants to set that rate is because it sets everything else. It's the basic price of money. Saltzman also mentions why interest rates are not the price of money, why it's a fallacy to say that they are a price of money. And I don't understand that thoroughly yet. So I can't comment on that too much more. It seems to me that the price of money, but he says it's a fallacy, and he's an economist with a doctorate, I believe. So get that, Richard Saltzman, if you're interested in why interest rates are not actually the price of money. But anyways, if this general stock market crash that was impending could have been left up to the private economy to look at and deal with, some people would have reserved their capital until after the crash, when there were scads of people out and about, and then they would have started this or that new company or whatever that was impossible to start before, because capital was just abundant and you couldn't compete unless you had a lot of capital. So now you can take minimum capital and compete in a situation you couldn't before. That's an economic opportunity. That's why throughout the 1800s the government never got into them. The government never came in to help or anything. And because of that, because the government didn't come in to help, all the resources that became available in the crash were quickly soaked up. That's right, I said resources that became available in the crash, because that's what happens in the crash. People who have overestimated the productivity of their firm they've invested in, people who have just gone with the herd and put their money in the stock market even though it looks like a bubble, people who have misallocated their resources stupidly lose them. Other people get them. In some cases that wealth seems to vanish. It's been reallocated. The stock market, when the price of stock goes up, someone buys in at 46, someone else buys in at 50, someone else buys in at 53, someone buys in at 58. Now the guy who bought it at 46 has stock worth 58 if he sells right now. That bit in there, the spread between the real value that it buys in at and the value that it can be traded at, then people own that stock at their own risk and buy in at that rate. They buy in at those higher levels at their own risk and should be free to do so. And when the economy has a correction, a year or 2 years goes by, some people get wiped out, learn a big lesson, the economy learns a big lesson, their neighbors learn a big lesson, the history books and the newspapers learn a big lesson, we move on. But the government gets in to fix it. That causes the problems. That's when the problems really get started. Anyways, continuing on page 1, we have a paragraph here. We'll go, after several months of depression, America was indeed a place turned topsy-turvy. Even the surface appearances of the cities changed. Former bond salesmen were on the sidewalks trying to sell apples. Former clerks roamed the business districts in an attempt to make a living by shining shoes.